So you might have guessed by the amount of seats that we have on the stage that we do have another panel discussion next. But the topic of the panel discussion is where it gets really interesting. So as you guys know, in the blockchain and the digital asset ecosystem, you always follow the institutions and where they're looking. So now we're going to be touching on institutions and their investments in digital assets. So I'm going to hand it over to our moderator now. We have Emmanuel, Aidoo, who will be moderating the discussion. So if we have a round of applause for our speakers. Thank you, guys. Hey, how are you? Yes, take a seat. And we have Thomas Lee as well. We have Melania Kohlhofer, Pat LaVecchia, and Will Peck. Welcome, guys. Enjoy.
Thank you.
There's mics on the seat.
Good afternoon, everybody. We have the unenviable task of coming after lunch when everyone's feeling sluggish and tired. So we're going to try and make this as interactive as possible. And I know we're thinning out a little bit. We've got people having coffee. But I just want to ask one quick question before we introduce ourselves by a show of hands. I mean, we're talking about the challenges of security tokens. I thought it'd be just a good little temperature check to who in this room believes that security tokens are, they're here, they're going to be they're the next best thing, or is it completely kind of we're all kind of crazy? Show of hands, who thinks this is like the next best thing? We're in a family here. This is fantastic. All right, awesome. So with that, let's just introduce everybody. So my name is Emmanuel Aidoo. I'm the head of digital asset investment banking at Perella Weinberg. A place I just joined 6 months ago. I can't believe it's already 6 months. Before that, I was at Credit Suisse for 25 years. Everyone in this room saying there's no way he's been at 25 years at Credit Suisse. He looks like he's 13. But I was there at the head of digital asset for like 7 years there before doing other senior roles. To my left, I've got Tommy Lee. Tommy, do you want to introduce yourself?
Sure. My name's Tom Lee. I'm the co-founder of Fundstrat. It's a macro research advisory firm. We've got over 250 institutional investor clients in 26 countries and roughly 6,000 family offices and RIAs as clients. And we really focus on thematic stories. I think one of the big ones for the next decade, and I'm glad a lot of folks raised their hands, is really digital assets, the productivity it's going to create, and of course, digital security tokens, et cetera.
Thanks, Tommy. To his left is Pat LaVecchia. Pat and I are ex-colleagues at Credit Suisse. Do you want to tell a bit about yourself, Pat?
Great. Thank you, Emmanuel. Great to be here. I was at Credit Suisse 20 years ago. So we crossed over for a few years. I'm a Wall Street guy. I was at Bear Stearns, JP Morgan. I was at Credit Suisse. I ran groups at both on a global basis. I got into crypto about 4 years ago, or blockchain. I was a skeptic 4.5 years ago. Got involved with the DeFi protocol. And what is Oasis Pro? Oasis Pro is a fintech and blockchain company globally. Oasis Pro Markets, where I'm the CEO and founder of both, is a full-service investment bank, underwritings, et cetera. And we also have a digital ATS for digital cash, like stable coins, CBDCs, Bitcoin, ETH, for digital securities transactions. We'll be launching in sometime at the end of June, early July on the ATS. We already did our soft launch on the primary. And we're obviously big believers in the digital security space and the growth. Thank you.
Thanks, Pat. And then to his left is somebody who actually looks younger than me, is Will Peck. Will?
It's because I didn't shave today. Name is Will Peck. I'm head of digital assets at WisdomTree. We're one of the world's leading ETF sponsors. I've been at the firm for 8 years, so not quite 25, but still longer than a lot of people in this room, especially in crypto. And I've been in my current role for about the past 2 years.
Thanks, Will. And then final, but no means least, is Stephen, who looks younger in his picture than he does in reality. That beard's looking great, Stephen.
Now you know I have the beard, Emmanuel. Hi, everyone. Stephen Prosperi at DTCC. I lead our product development area for digital securities management, which is a platform we're building right now to support the tokenization of assets in the private markets.
So let's just get to this, right? This topic is really about the challenges, right, that remain. And, I think I've been listening to several of the panels throughout the day. There is a ton of enthusiasm, for the space. We share the view of most of you who raised your hand that this is the kind of I won't say the holy grail, but it's the place that, where we're all going to, the digitization of equities, bonds, commodities, money, etc. It's a huge opportunity. But I think many of us are probably thinking, if we got to this space in 2014, 2015, maybe some of us 2016, we're thinking, what's taking so long? So that's what we're here to kind of think about, and that's what we're here to answer and address, and hopefully give people some thoughts. I think what I want to do maybe is start with Tommy, and just kind of figure out, it's a two-pronged question. It's one that talks about, breaking down the taxonomy, thinking about what is a security token versus what it isn't. And then, there were some comments earlier by, Ben Bernanke, for instance, on TV today, which talks about, Bitcoin being, gold having a use, which is apparently jewelry or something like that, and he talks about, Bitcoin having a use, which is ransomware. And is that type of sentiment what's holding us back? Is that, he clearly doesn't understand what this is, and we need to have a better way of addressing what it is and helping senior execs figure out, the challenges and differences.
Yeah, I'd be glad to start that way. I'm actually kind of curious, how many folks here are involved in traditional finance, but managing the distribution or creation of an equity or debt security? Could I just see hands go up? Okay, and then how about the rest of the audience? How many of you are investors in traditional markets? Okay, and then how many are crypto native folks here? Okay, great.
I knew that answer because everyone here is wearing blazers. If you were in Salt like 3 weeks ago, it was all like flip-flops and shorts.
Yeah, the reason I ask is that I think the answer to the question of, what is the taxonomy and what is tokenization of instruments, in a lot of ways, I think the simplest answer is that it's really just a technology solution, but it's really going to create efficiency and opportunity for new entrants. That's why when you look at what tokenization is, I think there's a lot of benefits to a traditional Wall Street firm, and Emmanuel and I were talking about how much technology has really improved the distribution of fixed income, but also equities. But I think the bigger opportunity and why things are created anywhere in technology, because I'm a former wireless analyst, is that it creates opportunities for a new entrant to grab market share. And today Wall Street and banking is really what you'd consider to be a highly concentrated industry, a high Herfindahl index, right? A handful of players control the rules and standards, and the market share is controlled by a handful of players. In fact, I would say 80% of all things that are sold in traditional markets are really controlled by 3 or 4 companies. Even looking at exchanges, it's a near monopoly business. And interestingly, it has not made finance cheaper. So I would say the biggest use case today, I'll just give a stat, is that McKinsey had this report. The average American spends $2,700 a year to have a bank account. I mean, that's 3.5 weeks of the average person's salary. So you might think Wall Street's very efficient because they have a lot of technology and cost of trading is zero, but it's actually gotten very expensive for the average person. So I think that is really the real opportunity in encompassing what's going to be happening with digital assets. And on the second point, and I don't know if you guys heard today, but former Fed Chair Ben Bernanke, or the Bernanke, has a book coming out Tuesday, and he had an interview. He's done a lot of interviews, but on CNBC today, he was asked about Bitcoin, and I don't remember the quote exactly, but he did say something along the lines that, gold, look, even outside of gold, it traded as an asset actually has a use case, but he says Bitcoin's use case is questionable. It's primarily to pay ransoms. And the reason, it's kind of, for anybody who's involved with Bitcoin, that that's actually not a true answer, but it really speaks to how the world today sees anything that involves innovation in the movement of money and securities. And just a small anecdote of why it takes forever.
Thank you. I want to move the question to Will, right? So in my seat at Credit Suisse, what I realized and what I feel like some of the challenges were around the space was that, an investment bank has around 700 steps that it takes, broken up into big, broad groups like risk and operations and client and reg. And the problem is most people only understand 7 to 12 steps. And so the challenge we have is this conveyor belt, right? And the most senior people at our institutions got really senior. I hope I'm sure everybody in here is really senior, by the way, so forgive me. But you got really senior because you're the best guys or gals at selling sausages, but you didn't actually work as the best people to make the sausage itself. And so how important is it, Will, when you think about in your role as the head of digital strategy at WisdomTree, that you have an understanding of the complete front to back and that your leadership group have an understanding of, how to make the sausage?
Yeah, definitely. I mean, for people who don't know, WisdomTree ETFs are core to what we do, right? And our CEO and founder, when he started the company in its current form, it was really started as a technology play, that ETFs were a better technology than mutual funds. It's actually, you go to today where there's, trillions and trillions of dollars, right? All the inflows going into ETFs versus mutual funds. And you can look back at that time, so call it early 2000s. No successful mutual fund company launched ETFs, right? It took new entrants, BGI, State Street, others, who had other elements of their business, didn't have this cash cow of mutual funds, to then launch ETFs. I think you can, kind of analogizing a little bit to today, you need to be willing to disrupt yourself, right? To look at what's going on, or what could go on, hasn't yet, but could go on with security tokens and blockchain for traditional capital markets infrastructure. And like you said, be willing to actually look at that problem and then disrupt yourself and do something new, which is very hard to do if you're in a kind of, especially an incumbent legacy institution, to be willing to do that. But if you don't do it to yourself, I think the idea is somebody's going to do it to you, right? So it feels like we're at that point right now. And kind of going back to one of the questions, I agree. If you went back, 2017 even, you'd think, oh, the security token market by 2022 would be so massive. Well, it's a two-sided market, right? And I think we are at the point where, the supply is starting to get there. We need to start generating demand for people actually to want to own security tokens, right? Just because you tokenize something does not mean that somebody's actually going to want to buy it. You need to tokenize something that has demand, right? And be able to generate that demand. And I think with all the innovations, a lot of the firms that are up here, we're starting to see things like that now.
So when Tommy asked the question to the audience, and he asked, I think most of the room were on the asset allocation side, right? So I'm going to ask this question to Pat. So as a person, I moved out of Credit Suisse, I moved to Perella, and I help companies like yourself, Pat, raise money and position yourself to sell yourself to many people in this room. And the way let's see if you agree with me, the way I kind of envision what you're doing is you've got traditional finance on one side, you've got Web3, I saw like 3 people put their hands up when Tommy asked. You've got Web3 on the other side, and you've got these entities with licenses in the middle that are helping bridge traditional finance to Web3. Is that how you see yourself, and is that how we help break down some of these challenges and barriers, and what am I missing, if anything?
Thank you. I think you're spot on. We're the bridge, but what we're focused on is a tipping point. So some examples have come out here. I think I'm the oldest one up here. I may not look it, but I think I am.
I might be you, by the way.
I'm sorry.
I remember the internet. Now it's ubiquitous, but when it came out, there was this cool thing called the email, and basically the internet for longer than that, 8 to 10 years was really a news source. And then it accelerated. There's, for the Wall Street guys out here, there's something called business development companies, which are all the rage since the 2010s. They've been in the market since the 80s. They reached that tipping point. ETFs, great example. 2004, what's an ETF? Why are we going to do this? It's going to be a small niche. Now I believe it's 80% of the trading on the market. Where we are is we have these really, and there are a handful of us that have these licenses, and we're trying to educate the regulators, because I give this example. The benefits of blockchain for institutional and for issuers and for the regulators is tremendous. Real-time data, lower cost, immutable records on trades. That's fantastic for the regulators. KYC, AML, everything's in place. But we got this thing called the 33 and the 34 Act. That's a bit of a problem, and that's going to take some time to break through. So where's blockchain today in digital securities? It's a Ferrari with training wheels. And it's ready to go, but it's going to take some time. So we are the bridge. We're doing the hard fight. We're making a tremendous amount of progress, but we need a tipping point. So what's a tipping point? A tipping point for me is issuers. It's not about going and getting the institutions and the retail, which is a fine model. I just think it's going to take some time to just come to digital securities and start trading it. I think the iPhone, what really brought about, we're all talking tech here, that was Apple. That was the tipping point there, right? And do we need an well, I'm old school, IBM, Tesla, Apple, these types of firms to start issuing digital securities. When that happens, that means the infrastructure's in place. And that's part of the problem, too, I think Tom was referring to, that the infrastructure's not yet in place. The rails are not in place. And until that happens with the custodians, until there's a streamlined process, and instead of the 33 and 34 Act, we're talking about the 22 or 23 Act, that we're not going to see the benefits, but we're putting up the hard fight for it right now.
Wow, there's so much to unpack there, right? Because I thought my interjection, when you said regulation, I was like, hey, Stephen, this is all you. Then you talked about the tipping point. I'm like, oh, Stephen, by the way, Stephen, this is coming to you next. So, like, DTCC, to most people in this room, is the most boring institution on the planet, and they have no place in a digital security token summit. But yet we find ourselves with our esteemed colleague, Stephen, on the end, who's going to explain to us why and what DTCC is doing to really actually enable, because I think this word infrastructure is one that we use quite a bit, but we actually don't know I think we sometimes talk past each other. I've heard people talk about infrastructure being a stable coin, infrastructure being exchanges, infrastructure being custody and transfer agents. So how do you see it? What role are you playing? And I know how this story ends, Stephen, so I'm going to save your punchline. What's DTCC doing in particular with the regulator to actually make the transfer, storage, and issuance of private assets actually a reality?
Well, I guess the first thing I'll say is I take the point, DTCC, traditionally a boring company, but infrastructure was traditionally a boring topic, right? In the past 5 years, there is conference after conference about the role blockchain can play to support infrastructure, to become those rails itself. And all of a sudden, we're back in the conversation here, because that's what DTCC does, is provide market infrastructure. Now, many in the room might be looking at me and saying, yeah, centralized infrastructure, we want decentralized infrastructure. And I think there's a journey to get there. Will made the point about disrupting yourselves before someone else does. We've been in the process of doing that for 5-6 years now in the blockchain DLT space. Now, what are we doing in this space? I think a lot of things, but the one most relevant to this conversation, I'll talk a bit about our DSM initiative, Digital Securities Management. We're trying to use our position both in the market, our regulatory licensing, and our clients, participants around the table to help move that space forward. So Pat mentioned 33-34 Act, right? There's this thing called customer protection rule. In order for a broker-dealer to hold assets on behalf of a client, they need to meet customer protection rule requirements, traditionally by pointing to a good control location to be able to hold those assets. This is where I start getting boring talking about the customer protection rule, but I think the main point here is if broker-dealers can't hold assets for their clients, then there are whole swaths of the community that won't get access to this. That's really the demand side. So you can fix the supply problem. You can get issuers to issue in tokenized form. But if those are only going to institutional investors or only to retail investors who are sophisticated enough to manage their own wallets, then you're missing out on probably where a lot of the retail accredited investor happens, through wealth management firms. So the punchline, I think, is what we're doing with our digital securities management platform is trying to help solve for that good control location problem that exists right now in the private markets and in the digital asset securities markets. There's a bit of overlap there, but that's the main thing that we're tackling.
I think one of the things that we have to all be cognizant of, right, is that the taxonomy is super important. And the way I like to think about it is you've got a digital asset, breaks into 4 pieces, payment tokens, you've got, let's call it security tokens, which includes commodities. You've got natural asset tokens, things like Ethereum and others. And you've got NFTs, which is basically digitizing property rights. And by the way, you may not be mutually exclusive. You might find things that actually fit into many buckets. And so, and questions coming to you, Tommy, and actually to you, Will, as well, next is, as we think about, the taxonomy, we think about how regulators tend to think about each of these different assets, because it's really about the asset is what's driving the regulator. In the US, we have a very fragmented regulatory landscape. I'm living here for 20 years, but I'm obviously English accent. The Brits seem to have figured it out. My prior, I used to work at Credit Suisse, so obviously that Switzerland seemed to have figured it out. The French have got a law which seems to figure it out. What's happening in the US? Are you seeing, it feels to me like this thing, security tokens, in the US anyway, lives and breathes with the regulation, or am I mistaken? Or can institutions move forward without them? And then are we disadvantaging ourselves in the US? Are we seeing other nations moving faster? Tommy, I'll start with you.
Got it.
There's a lot there, I'm sure.
Yeah, there's a lot there. I think that what's happening in digital assets and the battle with incumbency and regulatory inertia isn't that different than how the wireless industry evolved in the early 90s. And so I know today, and Pat mentioned the iPhone was a tipping point, but in the early 90s, that's really when I started doing equity research, was covering the wireless industry at Kidder. The industry had 34 million cell phone users, and the world population was still around 6.5 billion. And today, of course, there's over 5 billion cell phones, so the industry grew by more than 1,000 times. But back then, the wireless industry in the US was viewed as the stepchild of the landline and long distance business. So most people expected whatever happened in wireless was designed to protect AT&T, MCI, Bell Atlantic, and that even happened with the creation of digital cellular service, where there was very little agreement about how to implement a digital solution. And what happened was the US was sort of battling this multiple regulatory incumbency issues. Europe is really was the center of innovation. That's where GSM was developed and quickly implemented. And then I don't know if you guys remembered back then, but Europe was really the first nations to get to 70% penetration, which meant even children and grandparents had phones. But it also was the first countries to have double penetration, people having 2 devices. Italians had one for their family and one for their mistress. And then, and they were very early on what they called calling party pays. So the caller paid for a phone, but the receiver of the phone call didn't have to pay. In the world before phone calls, cellular became unlimited. That was a huge deal because a lot of people could afford cellular. So are the same challenges happening here in the US? I think so, because, and I think Pat could speak to it more elegantly, but today the big investment banks and the banking entities, the world works fine for them. They have great ROEs and they make a lot of money, and they're very quite cozy with the regulators, and they spend a lot of money really working with regulators. So I would say everything Emmanuel said is true, that it's potentially a regime or a region outside the US where a lot of this innovation will take place, and that could become the future epicenter of global growth.
Will, do you want to go next?
Yeah, I mean, I think, so WisdomTree's digital asset strategy, you can think about it twofold, and this is relevant for the question. So the first is around bringing crypto exposures to our traditional clients, mainstream investors. So people think ETFs, digital assets, they immediately think Bitcoin ETF, which obviously makes a lot of people in the US very angry, right? Because that does not exist here. We've had a product in the market in Europe since 2019, and the regulations just aren't matching up. So I think that's an example where a lot of people are kind of frustrated with the current tenor of the SEC and others. No personal commentary there. On the flip side, so the second leg of that strategy is around digitizing existing mainstream assets and bringing those to the crypto blockchain ecosystem. You know, this is why we're all here, right? And it's obviously been a little bit slower going, but I think the posture from the SEC and other regulators has been much more open-minded about this, about better technology that can improve consumer and the financial experience of a lot of people. I'm not saying that things couldn't move faster or there aren't some frustrations that people could have, but I think there is an open-mindedness about the potential of blockchain technology. And it's not like the rest of the world is like running away with this yet. You know, they've been talking in Switzerland about, you know, 6 digital for years now. And I don't think that's like taken the mantle from that the US could have on this front. So I understand the frustration on the kind of the crypto side, certainly from a Bitcoin ETF and other crypto asset perspective. Obviously, you know, is it a security or not for Ripple and things like that? Those are all things that we could talk about. I do think there's an open-mindedness, and maybe it's not as fast as some people would like, but things will kind of grow here in the US on the digital securities front.
And so as we think about like both your answers, right, in terms of the US versus the rest of the world, and we've got, you know, upstarts like Onera, for instance, who are aiming to kind of do a network of networks and make it more global. Is there a net, what's the right word? I'm trying to be more optimistic than challenges and say, should we be optimistic that, you know, US investors, which is probably most of this room, will have access to this innovation, won't be left behind? Maybe I'll start with Pat, and then, you know, since that's kind of your business.
Yeah, absolutely. Eventually, you know, the regulators. I agree with Tom's comments and Will's comments. Eventually, we'll get there. But you know, the U.S. is the leader in the market. I mean, there aren't any Bitcoin ETFs, but there's Grayscale. There's Wilshire Phoenix that's coming out soon, and others. So even though you can't do it directly, there's other opportunities to invest along those lines. The regulators are going to be, I don't want to be a naysayer up here because I made a big bet. We got some great issuers coming out, fantastic, will make the news. They'll help toward the tipping point. But the regulators are going to take time to get there. And part of their strategy is, and I completely agree with Will's comments, they are very open to technology. I think on an individual basis, they completely buy in. Most of the regulators that we've spoken to who've been around, you know, toward the younger side, 30s, 40s, and, you know, early 50s, I see a buy-in. But at the end of the day, they're going to watch what happens in the rest of the world because there are going to be problems. Look at, I forget the name of the hedge fund. There was a, you know, the hedge fund out of, that had all these forward contracts, et cetera, with everybody on the street. I think they've been indicted. The manager, he was running like billions of dollars. And these types of contracts have been on Wall Street for decades. And there are still these problems that come out, and you know, billions of dollars are lost. It has an impact on the markets, and it tails. It doesn't happen in one day. It takes a number of weeks. Look at what happened with 2008. There was a lack of information, which when smart contracts are incorporated into security tokens, you're not going to have. All the information will be in the smart contracts. AIG. Nobody knew that Lehman had all that exposure with AIG. What they were doing wasn't like a new instrument. It had been going on for decades. So the regulators learned from that, right? So I think the exact same thing is going to happen with blockchain. I don't think they're going to block it. I think with licenses, regulatory forward, compliance forward, companies like ourselves and others in the space will get over it, get over that hump eventually. But you know, it's going to take some time. That doesn't mean there's huge opportunities now, which there are, in my opinion.
Hey, So I'm convinced that this space is the place to be, and that's mostly because you can't ignore the amount of capital that's coming into the space in the VC land and the private equity, and it's just that amount of capital at play is going to be the thing that drives this thing forward. I have to ask the question because I think this morning's session I heard like Pat O'Mara and Vinny mentioned this about this ecosystem's big and everyone can play, and he talked about the collaboration piece of it. And so I'm going to go back to Stephen for this because I think you're kind of a collaboration bridge, helping others to kind of think that through. I'm going to ask a question to every one of you. How much do you believe collaboration is going to be a net benefit or a net accelerant to adoption versus, you know, we want to find the Apple or we want to find somebody else who develops that right product, that right fit, and then drives that forward? Start with you, Stephen.
Yeah, I mean, I think simple answer, collaboration.
Can we turn Stephen's mic up a little bit?
I can hold it closer too. I think collaboration will be key in this space, and I think many of the folks I see in this room are at companies that, you know, are competitors with each other, you could argue, but that doesn't stop them working together in the near term to bring this space to where it needs to be. I think it's great that the blockchain movement kind of comes on the heels of the open source community. I mean, one, the fact that smart contracts out there on public blockchains are available for anyone to see, but there's been this culture built on top of it where here's my code, go look at it for bugs, how can we work together? I mean, even the people sitting up here on this panel had great conversations with Pat, and he's kind of an open book of what Oasis is working on for the better of the market. I think it'll be interesting to see 5-10 years down the road where people, you know, find unique value, where their companies find unique value, and where they start to put those walls up. But right now, it feels like we're all in it together, and in order to get over this hump, it's got to be collaboration that gets us there.
Tommy, same question to you. Collaboration.
The collaboration is a lot more important in digital assets than in other technologies because it's going to be the basis for some sort of self-regulatory group to emerge. Because today, as you know, Wall Street has its own SROs, but they're really designed with licenses to really protect the industry. It's their own existing industry, so it's not really open to new entrants. And so, without question, that's going to be key. And I think it ties into also one of the big bottlenecks that exists, which, you know, is that you know, you have customers which are constrained because there's only so much they can understand and willing to risk, and the issuers face the same problems, and regulators. So I think to the extent that there's cooperation, it really addresses the fact that there is a really limited bandwidth for all the other cohorts involved with the space.
Before we continue, could I just ask those that are chatting by the coffee, because I feel like I'm competing with this kind of low hum, just to quieten it down. I know we're all here to network and have friendly discourse, but it's very distracting. We're collaborating over there.
Yeah, please collaborate by the coffee room.
Yeah, can you collaborate outside? So same question goes to you, Pat. Collaboration as a net hindrance or a detriment?
Absolutely, all in favor of collaboration. It's the only way this will grow. Just in the last like couple of years, if it wasn't due to collaboration, we wouldn't be up here discussing this, in my opinion. Speaking to the regulators, speaking to, you know, Treasury officials, obviously the SEC, FINRA, on a global basis, UK, EU. That collaboration is so important, and without it, we're not going to succeed. So we're big believers in that. But let me, you know, something I didn't, earlier I said I'm a big believer in this, and I think the opportunities are huge. For those of you who don't understand what DTCC does and what they've been doing since 1973, and what they're now doing with blockchain and T+1 in private securities that Stephen and Jen headed up, it's like taking a battleship and turning it around in the Suez Canal in seconds, just to give you a sense. And due to that, because we've worked with them, we've talked to them, and when they originally told us they were thinking about this, honestly, I was like, I'm not sure that's going to happen anytime soon. But that is one of the major players making a bet on this technology, and it's just going to be tremendous. And they're going to lead the collaboration because they have so much credibility across the world.
Thanks. Will, anything to add?
I mean, it'd be pretty stupid to do all this for global liquidity and interoperability and then just have a bunch of like little pools of liquidity. Like that would seem to be defeating the purpose. So collaboration is good.
Very cool. So just switching gears a little bit, right? So we've talked about regulation. We've talked about a little bit about the kind of the regionalism, regional bias. I'd like to talk a little bit about how we see the market developing itself from a regional perspective, not just the regulation part of it, but in terms of Europe, Asia, US. If we in the US don't get our I don't have to finish that sentence without using the wrong word. Don't get our act sorted out. There you go. Does it mean that we're going to be left behind, or is it really truly global and we're going to be fine? Steve, why don't you go ahead?
Sure. So I guess the first thing, and this ties into your last question too, just because we're a bit behind from a regulatory perspective right now, I think that's just lack of near-term evidence of innovation. But from what we've seen in the US, from parties coming together, from the technology being developed, and also the standards, what will be regulatory standards that these systems are meeting, I think positions the US very well that in the next couple years, while this gets ironed out, to immediately jump right back to the top there. I think we see very little breaches, data issues, things like that compared to some markets that may be more open. And ultimately, I think it'll be a long time before the US is completely unseated from our position in the capital markets.
So I think part of it is, I was trying not to ask this permission versus permission argument because I think, well, I won't say my view yet, I'll listen to you guys. But I think part of the challenge is because there's this bifurcation, it's the them versus us, it's a Web3 versus traditional, as opposed to we're all in it together, we're trying to make access ubiquitous for everybody, the fortunate as well as the unfortunate. I think it was Pat that talked about level playing fields, or this technology creates a level playing field. So I think my question though is, does it take in large institutions taking that brave step of understanding that there is that having a network like an Ethereum, a Solana, or I'm trying to mention as many as possible, so I don't say favoritism, Avalanche, etc., that these open networks are actually safe and secure. You guys are probably doing projects, whether it's permissioned or open. Do you have a view, anyone, on terms of Bitcoin, Ethereum, permission, unpermission, etc.?
I'll go first. I mean, we're focused on permissionless networks right now, and so we've got a prospectus for an open-ended mutual fund that can be issued shares on-chain. You can read it, WisdomTree Digital Short-Term Treasury Fund, just go to SEC Edgar. And we're issuing that on public networks. For us, that's where, not anything against permission networks or private networks, but that's where if you can do it on public networks, that certainly seems like kind of getting over the big hump. And there's a lot of potential there. Like that's where the ultimate promise of this seems to be. I think there are creative ways to kind of get around any compliance concerns or things like that. There's lots of different people trying to solve that. I can talk more about that, but I certainly think that's where we're focused on, and that's where we see the ultimate kind of prize being. Nothing against private permission networks, which can definitely have a time and place.
Yeah, I just want to add, Emmanuel, two things. First, at DTCC, we have projects both in permission ledgers as well as our DSM will connect to the public Ethereum network. And part of it is finding the markets where it makes sense. Right. Private markets, they're already generally aligned to individual shareholder name, lower transaction throughput, and we thought that was a great use case without having to flip an entire market on its head in a kind of big bang approach. But the other thing I wanted to mention is I think talking a lot to our own technologists and many at a lot of the large banks, when we talk about public permissionless blockchains, I don't think it's so much anymore fear of, is Ethereum actually immutable or is Solana? It's more about, is there enterprise-grade tooling and support to interact with those networks? And that's where it falls off when they look at their architectural standards and find out that the only node client is written in Go, and that's not something that the organization is willing to support right now. And I think that's not talked about very often, but many of them are comfortable now with the networks, just what's the infrastructure around how they connect to that network.
So in a minute, I'm going to ask everyone to crystal ball gaze with me, but before I do, let's just think about the opportunity and where it comes first, right? So we've heard real estate, I've heard private equity, I've heard private funds. We've got what's the view here as to what is the beachhead? Is it, does it even matter? I'll start with Tommy.
Well, I'm gonna give a very different answer because I think in a way, when people talk about what the, really where the S curve comes for tokenization, is it going to be a native digital asset, or is it going to be taking something that's physical or analog and then creating a tokenization? And I think those are very important, but I think the holy grail, or the really most important, is going to end up being financial inclusion, because that's the reason why WeChat took off in China. Was it really created access to financial tools for a lot of people in China that didn't have banking, and that's why crypto has actually flourished in Asia, is because it is inclusion. And even in other emerging markets, it's really the ability for people who are excluded having access to more secure way to manage their money. And I think even in the U.S. today, it's a surprising problem. I think 36% of Americans still have no bank account, and another 14% only use prepaid cards. So roughly half of the U.S. Is excluded from all the tools available that have been, really the SEC has been built to protect investors, but only half of Americans even have access to any of the products. So I think that's going to be the S curve.
Great point. Pat?
In 10 years, it's going to be ubiquitous. That's my prediction. Blockchain for capital markets, for democratization, more inclusion. But my background, like all of us, is Wall Street, but I fall way back on Wall Street, right? So where I think the opportunities are is where the banks really control everything, that Tom's earlier comments. So anything with cash flow is our focus, because the benefits of blockchain are just clearly evident due to the fact you don't need a third-party servicer. Again, we're KYC AML, but at the end of the day, that's our focus. That's what we think over the next 3 to 5 years. And we love equities and all that. We can do many, many things, funds, et cetera. But I think funds with cash flow, some type of cash flow distributions, products with cash flow, et cetera, that's our focus. Our discussions with the institutions have moved very, very quickly. That's always been our focus. And we think that, that trigger point will happen in that space. And we're also focused on DeFi. So, DeFi, which we really haven't chatted a lot about today, only a couple of hands went up, just wait. Because the opportunities for DeFi into the capital market space and every part of our lives is coming. And when that's incorporated, and we can talk about that at some other point, into the capital markets, rails, et cetera, it's going to be really exciting. NVIDIA was talking earlier about their ecosystem. Onera as well, in regards to collaboration around the world. That's part of this. That's like a movement that's taking that Wall Street and moving into DeFi as well. So that's our prediction.
So I think Pat moved us to predictions, and we've got 2 minutes left. So why don't I just use that and drift into predictions and ask Will, give me your prediction. What's the asset class that WisdomTree are betting on? Why? And what's the TAM? What's it going to?
We're focused on public markets somewhat uniquely for a lot of people here, I think, but really building a better user experience around kind of accessing public markets. So for us, that's our wallet app that we're building, WisdomTree Prime. You can go join the wait list. We're going to be out in beta later this quarter with a bigger rollout later this year. And that's my prediction, is you should download it.
And just to keep this kind of interesting, I'm going to ask a slightly different question to Steve at the end, right? It's like, actually, Steve and Tom, I'm going to come back to him. So many people are sitting in this room probably believing everything we've said up here, right? And agreeing wholeheartedly. And the only disagreement might be the timing. Like, this is coming, but I can wait. I can wait to see someone else fall flat on their face and then pick it up. Do you agree with that, Stephen and Tommy? And if you don't, what do you think?
I think it really depends what persona you're coming from. I think we've seen over the past couple of years every regulated and maybe unregulated type of financial institution dive into this space. I think there's a perception that in tokenized land, anyone can be the tokenizer, and maybe we'll get to that point. But I'd say if you are any form of infrastructure provider or custodian type firm, you need to be in it now, right? I think there's other firms in the areas, like we see kind of more direct asset managers looking at what would it mean to tokenize their own fund directly, and I think it's great to be in that R&D space, but I think when we talk about catching up on the regulatory curve, that's going to come later than the types of firms that are already regulated for doing similar services today.
Great answer, I like that. And Tommy?
Yeah, I think investors need to act with more urgency than banks or regulators. And I just have a simple anecdote to explain that. Like, for instance, most of us think in the last 20 years the big trade was FANG, or social media and internet, and that indeed was true, because $1,000 invested in let's say the top 100 market cap in 2000, by 2020, 96% of them fell off the earth, but 4% of them delivered a cumulative 16x return. So you basically could have been a lousy investor and stock picker, and only 4% of your picks worked, and you still had a 16x. But that's not how it only works. In the prior generation, from 1982 to 2002, the single best trade was buying retailers, which the top 7 had 1.7 million returns. So a $10,000 investment turned into 1.7 million. And it delivered the same return as FANG. I think as you look today, people have to ask, what do 20-year-olds care about? And it's clear that they care about digital assets, and that's how you're going to get the next FANG. So I think you do have to put a lot of capital here, and as Emmanuel mentioned, there's a lot, but it doesn't mean 90% of your ideas work. It really is going to be 5% that carries your return.
I think that's a great way to end this panel. I want to thank Tommy, Pat, Will, and Stephen for a robust conversation. Thank you.